We've talked about the sales comparison and cost approaches to value, and last but not least, we have one final method to cover. And that method is the income approach. It's a very important method for valuing commercial properties and is one that I think, as predominantly finance majors, you'll find most familiar because it uses a lot of the same fundamentals which you've learned in other classes. The main idea behind the income approach is that we directly convert the property's anticipated income into an estimate of value. If you're looking at two properties as an investor and you see that one is generating much more profit, you'll be much more likely to buy that one, right? And so will everyone else. So that more profitable property will invariably sell for a higher price. We'll use income capitalization, a simplified form of discounted cash flow, as one way to convert that profitability directly into an estimate of value. We call that a capitalized value, by the way. Capitalizing in this context means to convert a property's cash flow into a single estimate of value. Also note that there are some slight differences that we need to account for when we use the income approach for properties that don't yet exist. That is for development, and those differences are going to be beyond scope here, but you can be assured that essentially all that we learn here pretty much carries over to the development setting as well. Direct capitalization is the simplest method under the income approach, and it's used a lot for relatively smaller, simpler commercial properties. But there is more involved type of income approach called the discounted cash flow method. And this is a more generalized method which can be used for virtually any commercial property, regardless of complexity. So we'll talk about each in turn. First, the simpler approach called direct capitalization. This is used mostly in, say, 4 to 6 unit apartment buildings. Any more units than that, and the bank will probably require you to value using the discounted cash flow approach. But the direct cap approach is also commonly used by brokers and commercial real estate investors because it's a quick, convenient way to talk about the relative profitability of one property or another in a very standardized way. It makes comparing profitability across different properties fairly easy and quick to do. That's because a direct capitalization method talks in terms of multiples, sort of like how you talk about investing in companies and multiples. A company's stock might trade for 10 times earnings or a price earnings ratio, in other words, of 10. You can do the same thing with buildings. A building might sell for 12 times its income or 8 times its income. Looking at a ratio like that gives you a rough idea of how relatively expensive or cheap that building is compared to others in the area. Usually with a direct capitalization, we take the building's first year net operating income, basically net income, excluding interest payments and accounting depreciation, and then apply a multiple to that income based on multiples of similar buildings which have sold recently in the area. By contrast, the discounted cash flow, or DCF method, is a little more involved than just one number like a multiple. In the DCF method, you explicitly model the expected income that this property is going to generate over a specific holding period. 10 years is often used in practice, though this can vary. And then you discount that income back into today's dollars. It's a repeat of your corporate finance classes, basically, but for real estate. And it's used in practice for virtually everything other than single-family properties and smallish commercial. So if you ever felt you weren't learning anything useful in those intro to corporate finance classes, I feel you, but now is your chance to finally see some of those techniques in action, used in the real world. But the main idea with the DCF, and the reason why it's nice, is that it approximates the way an investor might naturally think about buying a property. When they look at a potential building to buy, they're not going to just say, it generates 100K of income this year. I guess it'll do that every year thereafter and probably will never require any upkeep. They're not going to think like that. Instead, they're probably going to adopt a more realistic, hard-nosed approach to the investment. They'll say things like, well, this year might be 100K, but the tenant lease is up after that. And when that happens, well, I can raise rents each year for 5% a year. But that roof is probably not going to have much life expected on it left. It's going to require a replacement in the next 3 to 5 years, and that's going to cost 50K. So I better account for that and maybe a few other things in my offer price. In other words, realistically, an investor, they're going to think about contingencies and what ifs and things that will vary in coming years, like rent. With a discounted cash flow approach, you can capture all that sort of flexibility and complication which actually occurs in real life investing. So this makes the DCF approach different than the direct capitalization or direct cap approach, as we mentioned earlier. Because the DCF approach models more complexity, it also requires more information as input into the model, like an estimate of how long a typical buyer will hold the property for, an estimate of income over that horizon, and an accurate discount rate in order to bring that future income back into today's dollars. But both income methods, they still amount to turning estimates of income into estimates of value. And in either method, we calculate income in a more or less standardized way. Specifically, we use something called net operating income, or NOI. With NOI, we start with something called potential gross income, or PGI. Potential gross income is the money that you'd anticipate earning either based on the lease contracts in place on the property or based on what competitive rents are in the market right now, if the property was fully rented out. So potential gross income is the income if the property is fully rented out, meaning no vacancies. And vacancies meaning a unit that in the property that's currently sitting empty, not generating income. Collection loss here, meaning that someone is in the unit, but they're late or refusing to pay rent. It's delinquent. These two, vacancy and collection loss, they get subtracted as a separate line item from potential gross income. Usually, rather than looking at actual vacancies for the property, we look at what's typical for the market and the property type we're studying. If most apartment buildings in this area are usually 10% vacant at any given time, then when appraising an apartment building, we subtract a 10% vacancy cost, regardless of what the vacancy actually is for that building. So that's a way of adding a dose of realism to our financial analysis. If the apartment has 0 vacancies and the rest of the market has 1 in 10 units empty, we know that this 0 vacancy thing going on right now is probably just a fluke for that property, and not something that's sustainable over the long run, given the statistics we're seeing with its competition. So that's why we often, though not always, use market-based figures for rent and vacancies rather than the property itself, the figures on the property itself over the last year. And this approach of using market-based figures rather than figures directly from the property's financial statements itself, that's called building a reconstructed operating statement. Okay, so potential gross income, that's the income that this property would receive or be expected to receive if 100% of those units were rented out, and then we subtract vacancy and collection loss. And then after vacancies, we add back miscellaneous income. Going back to our apartment example, this might be, as an example, income from coin-operated laundry machines on the facility. I mean, usually this is a small line item addition to income, if it's there at all. But we add it into the total to get something called effective gross income. And then from there, we can subtract out actual expenses with running the property, also known as operating expenses. So these will include things like basic upkeep repairs, maybe the cost of water or sewage if tenants aren't responsible for paying that, HOA, common area expenses, that sort of thing. In operating expenses, we don't include interest expense, income taxes, or accounting depreciation here. However, those things get excluded because they're very specific to the circumstances of the potential buyer. And what we're trying to model at this point is only the circumstances of the typical buyer. Basically, income tax rates, interest amounts, that sort of thing, those will just vary too widely by owner. And so putting it into the income figure here under operating expenses to get a market value, it's just not going to be meaningful. A final type of expense we'll subtract out is that of capital expenditures. Capital expenditures are replacements or alterations to the building which prolong its economic life. That is, which prolongs our ability to use it and rent it out. So this includes things like roof replacement, floor replacement, heating and air duct addition or replacement. Big capital costs which go toward the structure of the building in contrast to simple maintenance items like replacing a light bulb or a window. We don't always subtract out capital expenditures to get this net operating income figure. And sometimes when we do, we subtract out only a portion of the actual required capital cost if we anticipate that we'll only incur that cost at some point in the future. That's called setting aside reserves, by the way, where we put aside a set amount each year to cover these big ticket type of items. But once we subtract out CapEx, what we're left with is net operating income, or NOI. It's the income from a year of operations after accounting for all operating expenses and required reserves or actual expenses from capital expenditure. At its core, NOI is how much money the property generates for its owner. We'll use this NOI figure in either the direct capitalization or the discounted cash flow method in order to get a property value. Our example in that NOI walkthrough was of an apartment building, of a simple lease term. That's kind of what we're thinking about in terms of when we're walking through this here. In vacancies, we're talking about empty units and so forth. But with a simple lease term, we call that type of lease term a straight lease because there isn't any change to it each month. And it's basically negotiated up front for a fixed period of time. But it's worth noting that there are other types of leases that become more common when we start talking about commercial properties other than apartment buildings. So it's common in office building leases, for example, to include a step-up or graduated term lease. Office leases are long, and so a typical step-up provision might negotiate rent for the first 5 years to be X, and then years 6 through 10, X plus 5%, meaning rents increase by 5% each year in years 6 through 10. And then after year 10, contract is over and a new lease can be renegotiated, or the office tenant can move out, can vacate. An index lease is kind of similar to that, but with any increases tied to some external index. Most commonly, it's an index which tracks inflation in the US. So contract terms might be that for the life of a 10-year lease, rent should be X and annually increased by a rate of Y, where Y is that annual inflation rate that's in the economy at that time. And then finally, you have a percentage lease, which you tend to see mostly in shopping malls or small street-level retail. So here you have a component of rent, which is called a base rent, which is basically just fixed normal monthly rent. And then you have another component which varies according to the sales figure of the tenant. So if the tenant is an ice cream shop and they sell more ice cream in a month, their rent is a little higher that month because maybe their percentage component of the lease stipulates 2% of sales. So rent would be the base rent plus 2% of whatever sales are in that month. That's percentage lease. So percentage lease includes a fixed base rent amount. Usually it's kind of on the low side. And then also this percentage amount, usually a small percentage of that month's sales. With our concepts defined, let's do a walkthrough of an actual example of how we'd go about doing a reconstructed operating statement for a property, this time an office property. And then after we do that, we can use the income approach. We can use that income to do an income approach. So let's start with the numbers for this property. It's a 2-story office building, 8 office suites, 3 on the bottom and then 5 on the top. 2 of the suites rent at $1,800, and then the others range from $1,500 to $3,600. And rent increases are 3% a year as stipulated in the contract, so that's our step-up lease in action right there. And then in this market, we estimate that 10% of units are vacant at any one time. And operating expenses, typically 40% of effective gross income. And remember that effective gross income is out of potential gross income. Our full income as if fully rented, less this 10% deduction for expected vacancy. Capital expenditures, they're small, 5% of effective gross income each year. And then we anticipate that a buyer would typically hold a property like this for 5 years. Maybe a little on the short side, but conveniently short for an example and fitting it all into an Excel, a PowerPoint. One practical consideration you often face in this type of scenario is that some of your leases will expire during the holding period, during the period that you're modeling financial performance for. While the leases are still in play, you have to use the leases because it's contractually obligated, meaning that the renter is going to pay that amount that's specified in the contract, and that's really all there is to it. You can't change it until the contract expires. But once those leases expire, unless the lease terms have some sort of renewal option in place that dictate prices, which is unlikely, then the new monthly rents are going to adjust to whatever market rents are at that time. So the terms and timing of those leases will often affect what goes into the potential gross income calculation each year. Regardless of whether we use contract or our market rents, our potential gross income, that first line item in calculating NOI, is going to be a rental amount assuming that this office building is fully rented 100% of the time. And for this property, it's fully rented with lease terms already in place for each of the office suites. So we're going to use the contract rents to calculate potential gross income. And in doing that, we just sum up the monthly rents from each office suite. So suite is the word we often use when we talk about unit, when we talk about office properties specifically. And then we build that into an annual figure for the property. So there are 2 1,000 square foot suites, there are 5 800 square feet suites, etc. And all in, if they're fully rented for the year, that sums up into $180,000 per year in potential gross income. Note that since this property is fully leased and there are no leases which are expiring soon, that the work at this point is a little bit easy. If there was a vacant unit, then to estimate potential gross income, to estimate what the property would rent for if it were actually fully rented, then we'd have to estimate market rents for that vacant unit. And just so you know, here is how we would do that. Kind of like what we did with our sales comparison method when looking at recent sale transactions to see what a price range for the subject property might be, we can use rent comparables to estimate rental rates. So for this kind of thing, we usually don't need to deal with adjustments or anything. Instead, we just pick 3 to 9 comparable units. We find data on recently signed rents in this market for this property type and figure out what those equate to on a square footage basis, dollar per square foot. Then Then we multiply like a reconciled value. For, in this example, we're just using a rounded average of 1.94. And then we apply that square footage price per month from these comparable properties to the square footage of our vacant unit. And this type of analysis is also useful for kind of understanding whether the rents currently contracted for on the subject property are above or below market rent. In this case, going back to our previous table, if we look at the second floor rents, those 5 suites of 800 square feet each on the second floor, those are generating a total of $93,600 total across all 5 suites. So that $93,600, if we convert those contracted rents to $1 per square foot per month figure, then what we get, we see that the rents are currently rented on that second floor at $1.95 per square foot. And that fits nicely with what rents are in the market of $1.94 per square foot. What these rents are, showing for comparable rental properties. And if the contracted rents were significantly below this figure instead, that could be a cause for concern for this property with regard to property value. So in particular, if these leases have a number of years remaining before expiration and then they are below market, they're at a price per square foot that's below what we're seeing for our comparable leases, then the property value might be reduced. Because if a buyer's going to buy this property, they'd be locking themselves into a lower rental income than they could otherwise get had they chosen to buy a different property. So long-term rents, which are below market value, can result in price reductions for property, and for good reason. This isn't actually uncommon in San Francisco for multifamily properties. So there are stronger laws here against tenant eviction, and properties often sell, therefore, with long-term tenants in place. Usually they're paying they're paying rents amount that are below where current market rents are. So a buyer for this type of multifamily property that's looking at it from purely an income perspective is going to see that lower income locked in, and they're going to lower their offer price accordingly. After potential gross income, we can estimate effective gross income by subtracting vacancies here, as well as adding any additional miscellaneous income that might be generating by the property. And vacancies are also estimated both by what historical vacancies have been for the property over the years, if that information is available, often it's not, as well as the vacancy rates which are typical for that property type in its market area at the current time. What we're trying to do with this data is estimate a natural vacancy rate, meaning the long-term vacancy rate that normally occurs. Even in normal times, you still have some vacancies, even if it's like a small percentage, because a tenant might move out and it takes a little bit of time to find a new tenant, that sort of thing. That kind of vacancy, which just generally occurs no matter what, that's what we're trying to estimate here. And as mentioned, miscellaneous income might include laundry income. It might also include income from renting out parking spaces, vending machines, maybe renting out the clubhouse and an HOA for special events. These sorts of relatively minor things that happen to generate income, that gets added back. And in this case, our example office property, there's no miscellaneous income, which is kind of typical for an office property. So we have $180K in potential income, less 10% of that, $18K because of expected vacancies. And this 10% number, it's just an example, by the way, just depending on your property, it could be higher or lower in practice. In my experience, vacancies tend to be lower than 10%, closer to 5%. But there have definitely been unusual properties where I've seen vacancies at 40% or more. And different times, San Francisco, the market for office properties in downtown San Francisco, vacancies are quite a bit higher than 10% right now. Now that we have our effective gross income, though, we subtract out any operating expenses. And this is money that we spend because it's necessary to keep the property running, operating expenses. They can be fixed, like annual insurance payments or property taxes. They're fixed because they don't vary as a function of occupancy. So whether we have 5% vacancy or 50% vacancy doesn't change the fact that we have to pay the same amount in property tax on this property. But you also have variable expenses, which do vary with occupancy. And this includes things like utilities, water, sewage, garbage, and so forth, as well as maintenance and supplies. But when we say maintenance here, we tend to mean smaller things like changing door locks or fixing a sprinkler. Bigger jobs should be considered as capital expenditure. And we also don't include in operating expenses things like mortgage payments, tax depreciation, leasing commissions, all that. For these big jobs, that gets subtracted as CapEx. So roof replacement, HVAC replacement, major work on the parking spots, that sort of thing, these all would be capital expenditures. From a tax perspective, it's nice when you can deduct stuff as an operating expense rather than a capital expenditure, because with an operating expense, you can deduct it in the year in which you incurred the cost. For CapEx, instead, you have to amortize it in your taxes, meaning that you deduct only a portion of that actual expenditure each year over a fixed number of years. So if your deduction from CapEx gets pushed more out into the future, which, as we know from a present value perspective, is not as financially beneficial. Better to have that tax savings today and do something with the extra cash saved rather than push out that deduction into the future. And just be aware that sometimes you see CapEx taken out of NOI, and then sometimes you see it taken out after NOI. And this depends a lot on local norm and customs, as well as the norms for your property type. It does ultimately impact value, so just be aware to identify whether it's present or not when you're looking at someone else's analysis. Okay, so here are the operating expenses for our office property, subject office property, separated by whether they are fixed or variable. And in this example, we have some money set aside each year for our capital expenditures category for a future roof replacement, as well as some tenant improvements. Tenant improvements are things that the owner agrees to add as fixtures or improvements to the property whenever a new lease is signed. So examples of tenant improvements might be restaurant plumbing, if it's a new restaurant that's moving in, fiber optic lines, if it's a new office customer, these sorts of fixture or infrastructure type things, improvements that are specific to this new office tenant that the owner sort of kicks in for free. I mean, they build it into the rent price, but you know, they cover the cost for it up front for this new tenant. Notice that some of these things were expressed as ratios. So 40% of effective gross income, 5%, etc. You can find data on what ratios are typical for your property type and local area from a few different sources, including IREM, the Institute of Real Estate Management, and BOMA, which is an important industry group to be aware of, in particular if you're dealing with office buildings. There is a similar industry group if you're dealing with a shopping center, as well as a more generalist source of information, the Urban Land Institute. You can also get information from previous properties you've just worked on or seen before, or from your industry contacts who might specialize or work frequently with a particular property type. So as you work in the industry, you'll develop these types of contacts and you'll benefit by maintaining these relationships periodically. Local relationships and local information, it tends to give you an advantage in real estate to a much greater degree than in other industries. So finally, after taking out expenses, both operating and capital expenditures, we end up with net operating income. We call it a property's dividend because essentially it's the income. And you can think of it like a dividend yield in the sense that you can take this amount, this NOI, and divide it by the property's value or property's sale price, to give you, in essence, a yield, a percentage profit paid out as a percentage of the original sale price. A yield, just like the dividend yield of a stock. It's not technically a dividend yield to the investor because what the investor receives depends a lot on their particular selection of financing and their tax circumstances. I mean, if they're leveraging the property heavily and the interest is high, their effective yield might be much lower. So the net cash flow to the investor in that case could be low or it could be negative even if there's a positive NOI. So that's one of the reasons why banks, when deciding whether or not to lend on a property, they took a hard look at NOI first. And they need to make sure that this number is healthily above any interest payment amount that would occur if they lent. So they look at how much the interest payment would be each month on this property if they did do the loan, and then they subtract it from NOI. And then they make sure there's plenty of cushion in terms of cash flow. So they usually want at least 25% of the NOI still available to the investor after they make the debt payments, so that if there's like a downturn in the market and rents drop, then the investor still has cushion by which they can continue making payments on their debt. And if it's less than this 25%, they simply won't lend, or they'll require the borrower maybe to come up with a larger down payment, and so then a smaller loan size and therefore a smaller interest payment before they lend. All right, now that we've got the NOI for this property, we can convert that into an estimate of value. And we'll start with a direct capitalization approach. This is the somewhat simpler approach, what I might call the quick and dirty approach to valuation. We simply take the NOI and divide it by something called the capitalization rate, which most people just call the cap rate. And in the valuation world, this cap rate is not the same thing as a discount rate, but we'll get more into that when we talk about the alternative income approach that we're going to cover, the discounted cash flow method. And this capitalization rate comes from, as you might have guessed at this point, looking at sales of comparable properties. I'm guessing you're sensing a theme here. We can get cap rates from a comparable property by taking what effectively are those properties' dividend yields. So we get data on comparable properties which have sold, and then we divide those properties' NOI, specifically the NOI expected by the buyer during the first year of ownership. So that's what that one subscript is doing there. And then we divide that by the sale price actually paid by the buyer. And if a buyer buys a property for $1 million and the property is expected to generate $100K in the NOI in the first year, then this cap rate, R sub 0, is 10%. Like a dividend yield, we just find a bunch of these dividend yields, which were observed for some recent transactions of other property, and then we use that for our cap rate for our subject property, this property we're trying to value. So supposing we found 5 properties which sold recently, and we had good NOI data on them as well as the sale price, we can calculate cap rates for each of them, which is shown in that column here at the far right, labeled R sub 0. So these cap rates, they range, but kind of cluster around the average value of 0.084 or an 8.4% per year dividend yield. Cap rate, 8.4% cap rate. Note that these properties, they still need to be comparable. So we may not need to deep dive and do adjustments and so forth as we did in the sales comparison approach, but we need to make sure that they're the same property type, that they sold recently, and then these properties are in similar condition and a similar location to our subject property. There are some states where getting this data can be hard because sales data is not public information in those states. Differences in state law about that. But California is not one of those states, so finding comps here is a little bit easier. Okay, so we now have our 8.4% cap rate for this example extracted from the market using comparable sales. And our example office property that had $89K in operating income each year, then we can get a value for that property using a direct cap approach. And to do that, we take the NOI and divide it by this market cap rate. And that's it. Our estimate of value is $1.060 million. And once you have the NOI and the market cap rate to use, it's pretty simple, right? It kind of makes you feel like you should do some more work or something, like it was too easy to get to the finish line there. But really, that's it. That's all you need to do for the direct cap approach. And I mean, another way to think about why this is working and why it's okay, to stop at this point is to take a look at our estimate of value again, this 1.060 million here. Investors for this property type in this market, if they buy a property, we found that mostly they're getting a yield of 8.4% when they buy, based on our comps here. So it might vary, by 0.1% or so, depending on which property they buy from there. But that's just kind of where the market is right now in terms of cap rates, in terms of dividend yields. And so if they bought this property here instead for 1.061 million, what we're really saying is that that would be a fair price, because based on this property's 89K in NOI, that purchase price of 1.61 million translates into also getting a dividend yield of 8.4%. It's consistent with all the other properties out there. So that's why this direct cap approach makes economic sense. It's just, if they pay that price, they're getting a reasonable deal, something that's consistent with what's going on in the rest of the market. We can get cap rate information from a number of sources. Some of the more aggregated cap rate sources include RERC, realty rates, a couple of commercial brokers like Grubb & Ellis and Newmark. But if you want to get cap rates from individual properties, do your own selection of properties from which to get cap rates, kind of like this example here, then CoStar is going to be probably your best bet. But as mentioned earlier, it's very expensive to get a subscription to. Still, CoStar tends to be a necessary professional expense for most commercial real estate professionals. Cap rates, they tend to vary with interest rates and with economic conditions. In the 1990s, interest rates were higher than the first 2 decades of the 2000s. And so for some of this time period, depositing your money in a bank, the 90s, or money market account, it would generate like 6% per year. So cap rates, the yield on the property, which is a riskier investment than investing in a checking or money market account, they tend to be higher than that. And as interest and inflation rates dropped over the years, so did cap rates. But that changed during the real estate crash of 2008 to 2010, because real estate values during this time dropped dramatically. I remember buying my first property in 2009 at a price that was like 50% less than what the previous owner paid for in 2006. So it was a very dramatic time in terms of property values and general economic conditions. But so in that scenario, even if NOI stays relatively unchanged, those dramatic drops in prices, they cause cap rates to shoot up, because the denominator of the number, which makes up cap rates, drops, sale price. And so effectively your yield on anything you purchase at that lower price jumps. It's like a stock whose dividend stays more or less constant, but its stock price temporarily dips. Any real estate buyer during this time is hoping to sort of lock in a higher income yield. I want to emphasize that the cap rate's not the total return to a buyer of a commercial property. A buyer of a stock, for example, they get the dividend yield, but they also profit from selling at a higher price if all goes well. And in the same vein, a buyer of commercial real estate, if all goes well, gets the income from the NOI, but also gets to sell it for a higher sale price down the road. So the two combined lead to the total return from property investment. Let's say that this buyer of commercial property we're studying at the moment, they hold it for a year. They earn that 89K in NOI, and then they sell it for an increased sale price of an extra 21.1K over and above what they originally paid. And assuming no transaction costs to do that sale, just to illustrate, then this means that they get an 8.4% return from the NOI and a 2% return from that price improvement of $21,000. And so that 8.4% cap rate and the 2% appreciation rate together, that's the total return for property investment. I mentioned that cap rates, they tend to be used by professional real estate investors and brokers because it's a nice, easy number by which we can make a comparison from one property to another. By dividing income by sale price, it's easy to talk about and then compare two properties which might have quite different sale prices. It kind of puts them on a similar footing by talking in terms of yield instead of sale price, cap rates. But for less complex real estate, like for a single family house or duplex bought for the purpose of investment, in practice, some investors, they like to talk in terms of the effective gross income multiplier. And so this takes the proposed sale price and then divides by effective gross income, which is that income after allowing for vacancies. But this doesn't account for operating expenses, and so is more for simple properties without a lot of expected maintenance or running costs. It's not really used for professional real estate valuation because it really leaves a lot of stones unturned. But you will see this used from time to time in practice by investors in the market. So as an example of the gross rent multiplier approach, let's say we have these three properties, comparable A, B, and C, because we're trying to get a sense of what a typical effective gross income multiplier might be for this market in order to use this approach. So for each property, we just take the sale price and then divide it by effective gross income. And then this gives us our multiple, which across three properties here averages 6.49. So an investor might apply this multiple to the subject property's effective gross income to get a rough sense of what a fair price would be. And here, with our subject property's $162K of gross income, note that this isn't the NOI, that $89K we were looking at. This is effective gross income, so not accounting for expenses. We take that 162K and then multiply it by our 6.49 multiplier. And then that gives us 1.051 million, which in this case is fairly close to the value estimate we obtained from a direct cap approach. Going back to the direct capitalization approach, there are times when this approach is just not going to work well for us. And one of those times is when our subject property is stuck with below market leases or locked in with above market leases, which means like that the renters are actually paying more than it would be had they rented another property instead. So either way, this can be a problem in our comps that we have to look for when we're doing the direct cap approach. When we're getting cap rates from comparable market transactions, we have to make sure that those cap rates aren't influenced by these factors. So if we have a comparable which is locked in with below market leases, which can be the more common scenario, and that lease is expiring soon, the buyer on that comparable probably saw it and probably said something like, well, heck, the next year the lease is up. Sure, it's below market, but after that I can raise the rents to market rates then. So I'll just go ahead and pay close to full price for it. So I make sure that I win the bid, Makes sense for the buyer. But the problem is that if you use that property as a comparable, it's going to have a distorted cap rate. The NOI is going to come from below market rents because you're using that historical data, and so it's going to be an artificially low NOI. But the sale price, on the other hand, is reflecting the expectation by the buyer that they can raise rents in a year anyway, so they're not really factoring in those below market rates into the sale price. And so what you end up with in this scenario is like an artificially low capitalization rate for your comparable. So one easy way to avoid this is to look at the lease expirations on each of the comps, which is a great idea. It's more thorough. But You can also just generally avoid a lot of this by getting more comparables. And if you see a cap rate from a comparable which seems unusually high or unusually low relative to all your other comparables, you might just throw that one out. Or if you need to keep it, you can dig deeper into what this outlier cap is reflecting and whether you need to make an adjustment for it. In general, a lot of the problems that you're going to encounter with direct capitalization, it ultimately relates to the selection of your comparables when getting a market-based capitalization rate. Differences in lease terms, the amount of rent paid, or differences in operating expenses and how they're shared between the owner and tenant for this comparable compared to how they're shared for your subject property. Any of these can lead to a cap rate for your comparable, which doesn't truly represent what a cap rate would be for your subject property. And with a direct capitalization approach, it's not really usually feasible to adjust the cap rates for your comparables. It can be done, but it's not really easy to do. There's no pre-established method for it. And the sales comparison approach, if you recall, we are able to do an adjustment grid to adjust for differences between our sale comparables and our subject property. It's just not so easy to do something with capitalization rates of comparables. And so when I said that the direct cap approach was rough and ready, I really meant that rough part as well as ready, because there may be differences between our comparables and the subject property under a direct cap approach, which we really cannot precisely adjust for in the cap rates. And if we really need that precision, we instead at this point need to use the discounted cash flow approach. So I'll discuss that next. The DCF method for the income-based valuation, that can make more precise adjustments for things like above or below market leases, rent escalations, and etc. So I'm assuming at this point that you've taken at least one corporate finance class before taking this one. So I'm going to kind of skip over present value theory and so forth and just assume that you know what I'm talking about when I say present value. I do have a separate video in this topic section which covers how to do a DCF and present value formulas and all that in a spreadsheet. So definitely check that out if you're feeling a little rusty on the details regarding present value. But the best way to cover how to do the DCF approach as it is applied to property is, I think, with an example. And essentially, what we do with the DCF method is we utilize not just year one's NOI to get a property value, that $89K we've been discussing on this office property for the last few slides, like we would with a direct cap approach, but we also utilize year 2, 3, 4, and so forth. We model each year separately for every year that we anticipate this investor to hold the property. 10 years is common. In this case, we're using 5 years, although we're showing 6-year income here, but that will become apparent why in just a moment. But you can see that NOI is being modeled separately for each year, shown in this bottom row. And this is nice because it's flexible. If leases on this property expire 2 years into the holding period, then we can adjust year 3 through 6 potential gross income to reflect what rents would be based on market rather than what was actually written in that old lease contract. So this more accurately reflects the thinking of a typical investor. If a lease is expiring in 2 years, they're naturally going to think about what it's going to rent for after that and whether the rent can be increased. And here with DCF, we can account for that financially. We can account for these factors into our estimate of property value. Similarly, if we have a big capital expense expected at some point in the next few years, like a new roof, then we can put in one of the years that cost under CapEx, and that'll adjust the estimate of value appropriately for this anticipated cost. If you remember that we mentioned the total return to buying property is not just the cap rate, the yield, but also from any proceeds if you sell later at a higher sale price, then we can also account for that higher sale price using DCF. So in this way, we're modeling a sale price which includes the total return expected by a buyer, not just the annual income, but also any appreciation. And the way we do that is to model that final sale price and then incorporate it as a cash flow. Here it's being modeled a year 6 NOI, and then we're using the direct cap approach on that year 6 anticipated NOI and our cap rate, a cap rate, to get an estimate of value. So we're using the direct cap approach to estimate that this property will sell for $1.18 million at the end of year 5, a little higher than what was originally paid for it. And then we add this as a cash flow in year 5. So DCF is a way to directly model total return and add that, allow that to impact your estimate of property value. So that 1.18 million, as we said, that 1.18 million here, our estimate of what we can sell it for at the end of year 5, that gets added as a cash flow. Although, because we're being realistic and precise here with the DCF approach, we have to subtract it from anticipated selling expenses. Typical real estate commissions for a seller, they're going to be 3 to 6% of the sale price. So seller's going to have to pay, the owner is going to have to pay $47.2K to their broker for brokering the sale. And then that leaves them with less in terms of cash in the pocket, down to 1.13 million. And this 1.13 million number, that's actually what we'll use as a cash flow number for year 5, since we're selling it in year 5 on the basis of anticipated year 6 income. And this is all summarized in this table below. On the far left, you'll see each year of ownership, 1 through 5. In the second column, NOI, you have the NOI earned during each of these years of ownership. And then the third column, net sale proceeds, that only has a cash flow entry for the 5th year, because that's when you sell it and earn, when you net that 1.13 million in proceeds. So these two columns, NOI and net sale proceeds, they get added together to get a total cash flow for each year, shown in the 4th column. And then finally, because these cash flows occur in the future, whether it's 1 year out, 2 years out, or instead 5 years out, we convert these cash flows into what they would equivalently be if instead they were received today. This is because we're trying to estimate value for the property as of today. An investor who buys today, they're expecting benefits in the future, but they're paying money today. So they want to know what those benefits equate to into today's dollars and how that compares to the sale price they're thinking about paying. So if we assumed a discount rate of 10%, note that this isn't a cap rate, this is a rate based on the typical real estate investor's expected total return, cap rate plus appreciation, when investing in real estate, and so it tends to be higher than the cap rate. Then these cash flows, discounted to today's dollar at that rate of 10%, that equates to 1.06 million in today's dollars. And that's it. That's our estimate of property value using the DCF approach. If the typical buyer was expecting to earn a total rate of return of 10% per year by investing in real estate, and these were the true financials of the subject property, then this 1.06 million would be a fair price to pay. This would get him there. So at this point, we need to reconcile. We now have 2 estimates of value under the income approach, derived from 2 different income methods, the direct cap and then the DCF. Under the DCF, we have an estimated value, which we sometimes called indicated value, of 1.06 million. This is quite close to the estimate obtained from the direct cap approach of 1.061 million. And if these two diverge significantly by, like, say, more than 10%, you're going to have to dig in and explain why. Maybe see whether any of your assumptions about income growth, sale price, repairs, etc. are driving this difference between the 2 estimates. But in this example, though, we're pretty close to the 2 estimates. The 2 estimates are pretty close between each other. And so we don't have to worry about that. But we still do need to combine these two estimates into one. We need to reconcile these two estimates into one, and that's done by weighting them. And the approach is identical to the way we weighted comparables in the sales comparison approach. So here we have two different estimates of value, and we might have an opinion that one approach applies more to this particular property than another. So in this example, we're weighting the DCF analysis 60%, meaning we put somewhat more weight to its value conclusions compared to our direct cap approach, which we weight 40%. So multiplying our two indicated values by these weights, with the result shown in the far right column, when we sum up that far right column, we get our weighted value under the income approach. And this is our final single estimate of value under the income approach. Usually it's customary to round up or down to the nearest thousandth, or even the 10,000th if it's like a multi-million-dollar transaction or greater. And so that's why you see this rounded down here to 1.06 million. Given how similar these estimates of value were under the two income approaches that you saw in the last slide, I mean, they differ by 1,000, you might ask whether we really need to do both. And if you're doing real estate valuation for a bank, they'll often require you to do both methodologies as part of the assignment. Like they'll specifically ask for both in the contract. If you're a commercial broker, you might spend a lot more time using and talking about just the direct cap approach because it's simpler, it's easier to understand. Not everybody has the financial modeling skills to do DCF models, particularly if they haven't had any like formal college training in finance. So with the direct cap, its benefit is simplicity. We don't have to explicitly model assumptions like rent growth, make forecasts about discount rates, or really do anything other than look at the property's current NOI and current cap rates in the market right now. These two data points, that's like all you need for the direct cap approach. But I mean, while we aren't making any additional explicit assumptions, we are making a lot of assumptions implicitly when we use the direct cap approach. Essentially, we're assuming no change in the coming years with regards to rent, expenses, and maintenance for this property relative to whatever is going on with the property right now. And with a directed cap approach, we're assuming stability in the status quo, basically. And as long as nothing about this property is expected to change significantly in the coming years, then this is fine. But problems occur when you make these kind of assumptions implicitly and then they turn out not to be true. So if there's a major change expected for the property in the coming years, you really need to look at a DCF approach and model those expected changes explicitly.